Good afternoon, everyone. This is Joe Bacella here at Chaikin Analytics, and I'd like to welcome you to our presentation of how to leverage your profits in earnings season. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics. Now, as a reminder, this webinar is being recorded and a copy will be sent to everyone who has registered. Please submit your questions using the Zoom Q&A window, which is available in the upper left-hand corner of your screen. Now, Marc Chaikin created Chaikin Analytics to put the power of proven stock research tools in the hands of professional and individual investors. His latest contribution, the Chaikin Power Gauge Rating, is a proven 20-factor model that uniquely combines fundamentals and technicals. To get us started, here's a quick video. Enjoy the presentation.
85% fundamental, 15% technical. And I created the model because self-directed investors didn't really have the tools and the discipline to successfully manage their own money.
And that's created by famous analyst and entrepreneur Marc Chaikin.
I'm a big fan of Marc Chaikin, though, so it makes me nervous, Scott, because I like his metrics of looking at the market.
Marc Chaikin.
Marc Chaikin.
An expert known on Wall Street for developing computerized stock selection models.
Joining us is Marc Chaikin. He is the founder of Chaikin Stock Research. Mr. Chaikin, welcome.
Thank you, Joe, and welcome everybody. It's a great pleasure to do my first webinar of 2018, and the year has certainly started off with a bang. And now we're in the meat of earnings season. And so this afternoon's webinar is meant to show you how you can actually make money during earnings season, both buying stock or using options to trade earnings events. And we're going to show you very specific examples. Every example that we're going to show you on this afternoon's webinar is either from my weekly market letter, Market Insights, with a bullish or bearish stock of the week, from a previous webinar, or something that we talked about on television. So these are examples that everybody had access to before these trades became apparent. So I've been on Wall Street a long time, never really seen a year begin like this year began. 9 out of 10 up days the first 2 weeks, and we've continued very strong, even though a lot of the people on CNBC are talking about toppy markets and so forth. So what we're talking about here is the culmination of my life's work, working with smart, successful institutional investors, taking everything I learned from them and creating the Chaikin Power Gauge Rating. And this is going to become very clear to you as we go through the webinar, because in the next 45 minutes, I'm going to help you prepare yourself for 2018. We're going to start out by looking ahead at what to expect in 2018, show you how to find opportunities during earnings season, find winning sectors, groups, and stocks in the new year, and how to avoid losers, because it's going to be very important to play good defense in 2018, because it's not going to be that easy ride that we had in 2017. So we'd like to start off with a poll, and the question I'm asking today is, are you on board this bull train? So Joe, why don't you get that poll up? And tell us if you're bullish on the market, bearish, or waiting for a correction.
And we'll give that a few minutes. There's already been a great number of responses. Feel free to take a moment, go and respond right back in, and we'll show the results in about 10 seconds. And all right, let's go ahead and take a look. Mark, looks
so 57% bullish, 43% waiting for a correction, and only 1% bearish. So this is a crowd that's near and dear to my heart, because if you follow Chaikin Analytics at all, you know that we stayed bullish through almost all of 2017. And our first market letter of the new year, we were talking about a 6 to 12% advance in 2018. We've already reached the lower target area. We had a 2,800 to 3,000 target area. We've already reached the lower end of that target area. So let's take a look at a one-year chart of the SPY. This is the SPDR, the most actively traded instrument in the US markets, mirrors the S&P 500 index. So these are the 500 largest companies in the US markets. And as you can see, we haven't even touched the lower trend line in about 5 or 6 months, and we've broken out above the upper channel. This is making a lot of people nervous. Fortunately, on this webinar, we only have 1% who responded that are bearish, and there are some of you looking for a correction. The problem with that is it's very hard to time. And if you sit on the sidelines waiting for the correction, as many people did all through 2017, you miss out on a lot of opportunities. So what should you focus on in 2018? Well, the trend of corporate earnings is very important, and they're expected to be strong. First quarter earnings are expected to come in up 10 or 11%. The new tax cut bill, which reduces corporate taxes, is very bullish for corporate earnings, both in 2018 and beyond. Companies like Apple are repatriating cash. They're going to invest that in the U.S. economy. There's nothing that I see or look at that suggests anything but a continuation of the trend that we saw in 2017. An earnings-driven bull market, not just in the U.S., but globally. That's very powerful, as you'll see in a minute. You want to know where interest rates are headed, and you don't really have to be an expert because the Fed is telling you that they're going to raise rates 3 times in 2018. If the economy stays as strong as it appears to be, that's almost a given. So in a period of rising interest rates, as we're going to see on the next couple of slides, we know just where to go to look for opportunities. And you want to look at the sectors and industry groups that benefit from rising interest rates and the ones that get hurt by that. And most importantly, in 2018, stock selection is going to be extremely important because in a period of rising interest rates, stock selection, active management usually works extremely well. Now, the likely scenario for 2018 is here in the upper right-hand corner. And it's the same scenario we had in the final quarter of 2016 and 2017, namely higher interest rates and rising earnings. It's the second most bullish scenario, the most bullish we had coming off the bottom in 2009, which is falling rates and rising earnings. So I'm expecting that corporate profits are going to be up, corporate earnings are going to be up, and this is going to continue to drive the bull market. However, let's put pullbacks into perspective because I think it was 37 or 47% of you are looking for a pullback. Well, we didn't have a pullback in 2017 of even 3%. The last pullback of 5%, June of 2016, the Brexit sell-off, it was very quick. But going back to 1945, you should expect a pullback. So those of you who are looking for a pullback are on the right track because roughly once a year, we get a pullback of 5 to 10%. The average decline is 6%, typically lasts 1 to 2 months. But the interesting thing is the recovery time to a new high is 1 to 2 months. So you've got to be decisive to take advantage of that. So if you're looking for a pullback, have some cash on the sidelines, but not too much because we don't know when that pullback's going to start. Could start tomorrow, could start in April. There is no way to know. Now, bear markets come about every 6 years. So there have been 11 of them since 1945. It doesn't pay to stand around waiting for a bear market. These people on CNBC who are trying to make a name for themselves by pinpointing the top are not doing anybody a favor. So turn off the sound, watch the prices, and don't get influenced by the headlines. Because what's interesting about 2018, because we haven't had a pullback of 5% in almost 2 years, is that when we do get that pullback, it's going to feel like the end of the world. And you're going to have plenty of people on CNBC telling you that it is the end of the world. You've got to be prepared to take advantage of that. We're going to show you how as we go through the webinar. Now, what happens in a period of rising interest rates? It's fairly clear-cut. Going back to 1960, there are 5 sectors that benefit during rising interest rates: energy, technology, materials, industrials, and financials. They're the ones here on the bottom left. The sectors that do poorly are what's known as the defensive sectors, the high-yield utilities, telecom, consumer staples, and healthcare. Consumer discretionary is an outlier. So this is history. Let's see what's happening right now. This is from Chaikin Analytics. We can analyze sector performance. This is the performance of the 10 sectors within the S&P that have ETFs, the Select Spider Sector ETFs. Over the last 3 months, history has been borne out. Energy, technology, and financials all outperforming the S&P, materials just under it, and then the sectors that you would expect to be weak right at the bottom, utilities and real estate. And consumer discretionary, again, is an outlier because of the strength in Amazon, the home builders, some of the retailers. We've got a very strong consumer discretionary sector. So this is where you want to look for opportunities to buy. You want to avoid the interest rate sensitive stocks because as bond yields go up, big institutional investors are selling utilities and real estate stocks with the higher yields to go to the safety of bonds. Now, we've covered a lot of ground already, and it shows you one of the challenges that you face as a trader or an investor. Time is our most precious commodity, and there just isn't enough of it. There's a lot to analyze, tons of information. We call it a flood of information. It's hard to get out from under. And so at Chaikin Analytics, we created the Chaikin Power Gauge rating to help you cut through the clutter. It takes all of the data on the right part of the screen that fundamental analysts on Wall Street and at big mutual fund and companies like T. Rowe Price and Fidelity and Invesco, takes all the data that they look at and distills it down to that gauge on the left. Now, eventually, I'm going to have to get updated on that gauge. This is from a webinar we did in March of 2017. Lam Research had a very bullish rating. It was 127.80. It peaked at 220 in December. Pulled back, and yesterday it was up over 7%. So this bullish rating persisted over time. Now, all of this is embedded in Chaikin Analytics for both iPad and desktop. Centerpiece of everything we do at Chaikin is the Power Gauge rating, and we're going to show you why in a minute. And for some validation, it's being used by the pros, some of our old clients like Fidelity and Soros Hedge Fund, now the Paulson Hedge Fund. More importantly for all of you, it's been embraced by people like John Carter at Simpler Trading, and I'd like to thank John and his whole team for driving so many webinar registrations today. Also people like Jim Cramer at TheStreet.com, John Najarian. And as you'll see at the end of the webinar, Benziga, which is a internet news service and analyzes earnings, has really blessed Chaikin with something we're very proud of. We'll show you at the end of the webinar. So in this afternoon's webinar, what I'd like you to come away with is the feeling, the belief, the knowledge to find trades like this Red Hat trade. Here's a software company, Red Hat, RHT. Back in August and September, everything that Chaikin looks at was positive. We're going to walk through a chart in a couple of minutes. This is sort of a teaser. And using one of the signals in Chaikin, an oversold buy signal, which happens when our power gauge rating is bullish and the stock makes a new 8-day low, we got that signal triggering right before an earnings report. If we look back at the previous 2 earnings reports, colored green, that means they reported a positive earnings surprise, and each time they spiked up. So if you were knowledgeable and watching for an opportunity to get into Red Hat ahead of this earnings report, you would have benefited from that big spike, and the stock never looked back. It spiked up from 105 to 112, and ultimately it was 125. Options traders did extremely well. So this is what I'm going to focus on in the balance of this webinar: how to find stocks like Red Hat, how to find short candidates for put options trades in earnings season. There's enormous opportunities on both the long and the short side. But everything that we do at Chaikin is driven by the fact that fundamentals drive the market. Fundamentals do drive the market, but emotions drive the market to extremes. So the path to profits for me has always been to combine fundamentals with technicals. The biggest problem relates back to the fact that we don't have a lot of time and there's so much information to analyze. So Chaikin Analytics removes the emotions and gives you a directional edge. This is the whole key to successful trading and investing. Having a way to analyze the fundamentals that you believe in that works so that you can combine them with two simple technical indicators. And we do that analysis in this multi-factor model we're going to dive into in a minute so that you have some confidence that it really is grounded in reality instead of some theoretical model that's created by a PhD. And then we give you buy and sell signals, 6 pairs of buy and sell signals for better entries and exits. And during earnings season, this is really your key. Having the directional edge that the power gauge rating gives you by analyzing these 20 fundamental factors, and then some sell signals to help you pull the trigger. All of this can be distilled down into this pyramid. Successful trading demands a disciplined methodology. When we revert back to volatile markets, as we will, in my opinion, in 2018, a disciplined methodology is absolutely critical. So at the top of the pyramid, the power gauge rating, it's central to everything we do. If we're trading the long side, we want the power gauge rating to be bullish. We also want to focus on strong sectors and industry groups. That is another way to put the wind at your back. At the bottom of the pyramid, just 2 technical indicators, Chaikin Money Flow, which many of you know, it's on all of your online brokerage platforms. I created that in 1981. It's been in the marketplace for over 35 years, and it's helped both individual and institutional investors see where the money is coming from and coming out of. And then Chaikin Relative Strength, our unique way to determine whether a stock is outperforming or underperforming the market. And then right there in the middle, that sweet spot, Chaikin buy and sell signals. So in this webinar, we're going to focus on 4 keys to timing winning trades. First, you have to find the best bullish and bearish candidates. We're going to show you how to anticipate future price movement with a secret that we've been teaching institutional investors and now our Chaikin members and people who attend these webinars for many, many years using Chaikin Money Flow. I'm going to show you how to use rules-based entries and exits to improve your timing, and also how to play good defense. And as I said, 2018 is going to be a stock picker's year. You're going to have to avoid landmines that destroy portfolios in order to protect your capital. But you can turn that around and make money on the downside, as you'll see. So at the heart of this, as I said, Chaikin power gauge rating. The display is very simple, but under the covers, there's a lot of number crunching going on. So what I like to say on these webinars is that the Chaikin power gauge rating is like a Chevrolet with a Ferrari engine under the hood. And it can be your GPS during earnings season. So here's what the power gauge rating is made up of. We look at value, growth, technical, and sentiment factors. Within each of them, there are 5 individual factors. So value is 35% of the model. Looks at a lot of the factors that Warren Buffett looks at. Growth, particularly earnings surprise and earnings consistency, very important. So during earnings season, we get positive and negative reports versus analyst estimates. So if you get a positive earnings surprise, that leads Wall Street analysts to raise their estimates. I learned this from a colleague at Drexel Burnham in the mid-'80s, George Douglas. What he taught me was 2 things. Earnings surprises come in bunches. There's never just one of them. They persist for quarter after quarter after quarter. Lam Research, 14 or 16 quarters in a row of positive earnings surprises. More importantly, earnings surprises cause Wall Street analysts to raise or lower their estimates, and analyst estimate revisions are the single biggest short-term driver of stock price movement. So the value metrics are like the foundation of a house. They don't change that much, but they give you that solid confidence that you're dealing with a company that's well grounded financially, or poorly if you're looking for opportunities on the short side. And then you've got some of these more sensitive metrics. Now, there's a common thread here. I work with institutional investors for over 30 years. These factors are what successful institutional investors look at every day. Now, they don't all look at each of these factors. This model is 85% fundamental and 15% technical. Successful Wall Street investors use these factors. So we're really modeling what a successful investor would look at. Now, if you're a trader, it's important to realize that the best trades come in stocks where the institutions are buying it on the long side or selling it on the short side, as we're going to see in a moment. So this is what I call a reality-based model. Multi-factor models have become all the rage now. As you'll see in a few minutes, we actually have two exchange-traded funds, a large cap and a small cap, based on the power gauge rating as the final criteria to create indexes that are rebalanced annually. 430 million being managed in those two ETFs, and the first one launched in May, so haven't even been in the marketplace for a year. The key here is that this model reflects my 50 years on Wall Street. Everything I learned from colleagues and institutional clients of mine is distilled down into this model. Now, in 2016 and 17, it was pretty much a cakewalk. Strong stocks, strong industry groups, power gauge rating bullish. It wasn't that difficult to make money unless you outthought it and made it too complicated. But in 2015, when small caps and energy stocks were in a bear market, the power gauge rating really proved its value, because the average very bearish stock in the Russell 3000 was down over 17% in 2015. So there was a bear market. Anybody that tells you we haven't had a bear market since 2009 is missing the fact that there was a bear market in small caps and energy stocks in 2015, and that ended in February of 2016. That's really when this bear market, a bull market, began. So we've had two bull markets since 2008. In my view, the power gauge rating becomes very important in corrections and in bear markets. Now, I mentioned that we have two exchange-traded funds. They're based on indexes that we created for NASDAQ in 2014. Those three indices are all outperforming their benchmarks, and because of that, New York Life Insurance investment subsidiary, New York Life Investments, and their mainstay wholesalers licensed all three of those NASDAQ Chaikin indices, and the first ETF they rolled out was the IQ Chaikin Small Cap. This is not a recommendation to buy the ETFs. This is a way of validating the power gauge rating. And both the large cap, which was launched in December, and the small cap have been outperforming the Russell and the S&P since they went live. So this is the validation that I want you to walk away from this with. If you believe in the power gauge rating, you're 10 steps ahead of everyone else who's trading without it. So we've defined two patterns: classic Chaikin bull and classic Chaikin bear. And we try to keep it simple. So a classic Chaikin bull is a stock with a bullish power gauge rating, which means the fundamental factors are favorably positioned, that's outperforming the market with strong Chaikin money flow. So here's a very conservative company, Cigna, that has all the characteristics for the last year of a classic Chaikin bull. Power gauge rating is a ribbon at the bottom of the chart. This is a one-year chart of Cigna. Stock has gone from about 150 to 210, actually 220. And the power gauge rating has been bullish all year. It's been outperforming the market. That's a pattern that we love, and we'll get into that in a minute. And for most of 2017, the institutions were buying it. And the way we know that is that Chaikin Money Flow was green, big mountains of green with smaller pockets of red. Everything you need to know about trading a stock is on this screen. These are our oversold buy signals. They work about 2/3 of the time. They're great for trading options. These trades tend to last for about 5 to 15 days with about a 66% accuracy. And then it's very important to know what the trend of earnings estimates are. Up here on top, we have our earnings indicator. It's either red or green. In this case, Cigna, who reports earnings on February 1st, has a bullish earnings alert indicating that analysts are raising their estimates. It's in the strong insurance group. Everything is going for it. It's a classic Chaikin bull. Now, it's wonderful to know that there's a pattern that may help you find winning stocks, but how do you zero in on them? Well, within Chaikin Analytics, we use a screening program that we've developed to screen any universe of stocks. In this case, for a webinar that I did on May 24th, I screened for classic Chaikin bulls. So power gauge rating, very bullish. strong money flow and relative strength, I added just one other factor, which is I wanted a history of positive earnings surprises for all the reasons that we've already mentioned. So running this screen prior to that webinar using the Russell 3000 as a universe, large and mid-cap stocks, 13 stocks passed through the screen. Since May 24th, the S&P 500 is up almost 16%, and these 13 classic bulls are up over 24%. So 50% better performance. But as you just saw with Cigna, there were wonderful trading opportunities using these oversold buy signals to get into Cigna for both short or intermediate term trades. Same was true with Anthem Health and some of the other insurance stocks and some of the aerospace stocks. So a very powerful tool to help you zero in on the stocks you want to be trading from the long side or putting into your 401k plan. Classic Chaikin Bear, just the opposite. Power gauge rating is bearish. Stock is underperforming the market. Chaikin Money Flow is weak, not strong, telling you that institutions are selling the stock. Now, this is a chart of Under Armour. It's a one-year chart. The power gauge rating on Under Armour has been bearish for over a year. Sadly, the stock has significantly disappointed the big hedge funds and institutional investors who had very large hopes for Under Armour, particularly when they signed Steph Curry, champion basketball player, to a big multi-$100 million sneaker contract. Power gauge rating on Under Armour turned bearish at $40 back in 2016. It has stayed bearish. Anybody who is bottom fishing in Under Armour has a big loss right now. And it's important to know that bottom fishing is what I call the most expensive sport in America. It's very difficult to do. It's hard to pinpoint bottoms. You hear people on CNBC all the time saying, well, maybe now's the time to step into Under Armour. But as you can see with this recent negative earnings surprise when the stock dropped from 16 to under 12, this can be very, very difficult. So you want to avoid the classic bears. Now, we're going to pull all these indicators together and put labels on them. So 3 key indicators, 3 important takeaways. We're going to start with the dynamic duo. Dynamic duo is the combination of fundamentals and technicals, so the Chaikin power gauge rating and Chaikin relative strength. When they're both in the same direction, the dynamic duo finds big winners and losers. And that's where you get the outsized returns that we just saw on that screen. 50% better than the S&P with large cap stocks. In small cap space, could be 100%. There's one caveat though. Relative strength stands alone as a bullish or bearish indicator. Now, what do we mean by that? Well, there are stocks everybody knows that are known as momentum stocks. Many of these stocks don't have the fundamentals to support them, but they have a great story, like a Tesla or Amazon, which has a really good story. On the downside, you have stocks where relative strength is very weak. We're going to see an example of that in a few minutes. General Electric. The power gauge was neutral, but General Electric was bearish based on relative strength. So you can get a move based on relative strength, but be aware that if you're trading stocks and the power gauge is not supporting the price strength, that you got to be very, very careful in managing that trade, because if it turns against you, very difficult to get out and very difficult to spot what's going on. So here's an example of the dynamic duo on the upside. This is Centene, a major provider of healthcare. It's a one-year chart going back to January of 17, and the power gauge has been bullish the whole year. It started outperforming the market here in February when the stock was trading at about 65 on the way to 110. One of the best performing stocks in the S&P 500 last year. The signals on the screen are what we call our relative strength buy signal. So this is a really powerful signal, and I want to spend a few seconds on it. It typically doesn't care about the power gauge. It just cares about whether a stock is outperforming the market to get a relative strength buy signal. So if a stock is outperforming the market, which means it's green in the Chaikin relative strength histogram, drops under its 21-day average, and then goes back above its 21-day average, that triggers a relative strength buy signal. Now, the 10 best performing stocks in the S&P in 2017, 8 of them had a bullish Chaikin power gauge rating for all or part of 2017. In those 10 stocks, there were 24 relative strength buy signals. 23 of them were winners. And the beauty of this signal, let me repeat that, 23 out of 24 winners, is that these trades tend to persist for 4 to 8 weeks. So you can use them for swing trading. You can use them to add stock to a 401k plan. You don't have to worry about short-term options expiration. You can take a longer view, establish positions, and let the stock breathe and run on the upside. Now, on the downside, here's what a bearish dynamic duo looks like. This is Avalon Bay Communities, one of those real estate stocks that is going to be hurt in a rising interest rate environment. They also have a lot of rental properties. So as we're going to see, if we look at DR Horton, millennials are starting to buy houses. So they're not doing as much renting. And so here's what happens on the downside. And look at those wonderful money flow sell signals when the stock rallies up and then reverses back to a downtrend. This is an example of the dynamic duo on the downside. These are stocks you want to avoid because here's a stock that's making a new 52-week low while the market's making a new 52-week high. Think about that. So the dynamic duo on the downside, relative strength sell signals, 8 of the 10 worst performing stocks, including Under Armour, in the S&P 500 last year had power gauge ratings that were bearish for all or part of 2017, and 85% of the relative strength sell signals were profitable. So you're putting the odds on your side. The power gauge rating gives you the directional edge. Relative strength confirms it, and then you look for the signals, and these trades have high probabilities. So the second pattern we want to talk about is what we call personality changes. And I think it's really the key to making and keeping profits. So what is a personality change? It's a stock that was outperforming the S&P, so our relative strength indicator was green. That becomes red, meaning that it's starting to underperform the S&P, or vice versa, underperforming and then outperforming. The reason it's so important to spot these is because we tend to get stubborn as investors. Institutions, traders, individuals, human nature is the same. You get an opinion on a stock like an Under Armour, you're bullish on it, you like the Steph Curry relationship, and you don't spot the personality change. So let's see what happens when you get a personality change. This is Michael Kors. It's an apparel stock that was in a big downtrend, underperforming the market with a neutral power gauge rating. And then you got a positive earnings surprise that came out of the blue back here in August. The stock spiked up dramatically from 35 to 45. And that caused a bullish personality change, also caused the power gauge rating to turn bullish. Why? Because analysts were raising their estimates. You had a positive earnings surprise for the 4th quarter in a row in a strong industry group. Once you've had a bullish personality change, you want to look for the first buy signal. You don't want to chase that spike up. You want to wait for that pullback. You got it back here in August with the stock at around 42 on its way to 66. We wrote this up in our market letter, talked about the apparel stocks, highlighting Michael Kors. So there's your oversold buy signal. By the way, all 6 pairs of our buy and sell signals are explained on our website. Whether you're a member of the Chaikin community or you're just a visitor, go to chaikinanalytics.com. You'll see these 6 pairs of signals explained. And this is really powerful. So notice how earnings surprises come in bunches. Because after this first opportunity to buy into Michael Kors, you got a second opportunity here on a new 8-day low, and then another positive earnings surprise, and then the stock just took off. So you had to be in before the earnings surprise. Sometimes you get a chance to get in afterward. If you get in before, that's even better. Now, here's a drug stock that's been in its own bear market. Tesaro, it's in a weak industry group, the drug group. It's a weak technically. You had a bearish personality change back here in March when the stock dropped under its long-term moving average, started underperforming the market. The stock was trading at around 140. Along the way, here are your relative strength sell signals. So the stock since March has dropped from 140 to 60. Bottom fishing just doesn't pay. And you had these wonderful relative strength sell signals. Typically, they're 70% accurate. The power gauge, along with the weak relative strength, really makes this a very potent trading signal. Now, back in 2016, SunEdison experienced a bearish personality change. This was one of the darlings of the solar energy industry. The stock was owned by big hedge funds, was recommended by Merrill Lynch, and the power gauge rating turned bearish at 30. Stock started underperforming the market. There's your bearish personality change. And look at the institutional selling. Chaikin Money Flow was red all the way down from 30 to $3. Now, this chart ends in April of 2016. The reason is the company filed for bankruptcy. Now, Merrill Lynch, which had been recommending it up here in the 2830 area, did finally put out a sell signal. It's not a knock on Merrill Lynch. Every brokerage firm has the same pattern. They put their feet in cement. Where do they put out a sell recommendation? In February of 2016 at $3. And because of that, at a conference in 2016, I was demoing our system to an advisor from Merrill Lynch out in California, and he said, oh my God, I averaged down on SunEdison at 15 because Merrill Lynch was still recommending it. If I'd been using Chaikin, I would have saved a lot of pain and money for myself and my clients. And that's what this discipline is all about. Key in on the stocks you want to trade on the long side, know when to exit, and know what stocks to avoid. Now, I promised you a very special signal, and 95% of traders don't even look for it, don't know what it is. We call it a bearish money flow sell alert. And it gets triggered, as it did here in Advanced Auto Parts back last year when the stock was trading at 170. It gets triggered when the stock makes or equals a previous high, gets overbought, and Chaikin Money Flow, instead of going green, stays red. What that tells you is smart money is exiting the stock. Under the cover of price strength, they're liquidating their holdings. And that's what you saw in Advanced Auto Parts here in January of 2017. And the institution just kept selling it. Then you got a bearish personality change, and we're going to see how we took advantage of that for our members in our weekly market insights when we look at earnings season and what you can do with it. So we call this a bearish money flow sell alert, and we're going to see a couple of other iterations of that. Now, everything we've been talking about up to now is something that Warren Buffett calls the ideal setup. Warren Buffett has said they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. He calls it the fat pitch. We call it the ideal setup. The missing piece are the signals. That's your trigger to get into a trade. So 6 pairs of buy and sell signals. You've seen examples of them. Let's take a look at how we zero in on those signals. This is our alerts dashboard from our iPad app. We have it on the desktop as well. For every list, index, ETF in the system, and we have multiple list capabilities, you see what stocks triggered buy or sell signals every morning. So back in August, in a very large list that I monitor for these webinars and to write my market letter, Boeing triggered an oversold buy signal at 234, and Bed Bath & Beyond triggered a relative strength sell signal at 29.78. Let's see how they turned out. Boeing had just reported a positive earnings surprise in August. It then pulled back. Does that look like Michael Kors to you? If it does, please type a Y in the question box. Big difference is, didn't have a personality change because Boeing had been outperforming the market since January or December of 2016. So this is 2017. You got a pullback. There was your buy signal at 224. and the stock went all the way to 350. Got a second relative strength buy signal. I'm sorry, oversold buy right here after the next earnings report. So sometimes, as I said, you get an opportunity to do it before the earnings report. Sometimes the signal comes afterward. And that signal came at 260. Again, this is a stock, classic Chaikin bull, all through 2017. Now, here's the Bed Bath & Beyond relative strength sell signal in August. The stock was just under 30. Notice that there had been two signals, one before and one after, that came right ahead of earnings. This is what this webinar is all about. If you have a disciplined way to know whether a stock is likely to underperform Wall Street estimates or outperform, and then you get a signal ahead of earnings, you have a very, very powerful, profitable trade in the making. So if the power gauge rating is bearish, the stock is twice as likely as the average stock to report a negative earnings surprise. That's what happened here in June, and it happened again in September. And then this signal that came back here was at 29.78, and Bed Bath & Beyond, which is now turned bullish, bottomed out at 18.50. So these were very profitable signals. These gap downs after a negative earnings surprise mean that a put position, and we love vertical put spreads as opposed to just buying puts outright. But however you play the downside, these are great opportunities to make money during earnings season. Now, we talked early on about what sectors do well in a rising interest rate environment and how important group and sector strength is. We're not going to focus on that in this webinar because the balance of the webinar is going to be about playing defense and finding opportunities during earnings season. But we have a way within Chaikin Analytics to zero in on which sectors are going to do well, not by looking at price strength, although we do that as well, but by looking at the number of the stocks within each of these sectors with bullish versus bearish power gauge ratings. So we're looking under the hood of an ETF, or a sector in this case, to see what the individual stocks look like in our 20-factor model. We call that the power bar. And notice that energy, financials, technology, and industrials, consumer discretionary, all have very positive power bar, along with healthcare, and lo and behold, real estate and utilities, which have been underperforming, negative power bars. So very bearish if there are few bullish stocks and a lot of bearish stocks. That's why we've been able to zero in on the real estate opportunities on the downside, like Avalon Bay. Now, we talked about the importance of playing good defense. That's important in any year. In 2018, it's going to be really important because it's going to be a stock picker's market, in my opinion. So how do you play good defense? Well, it's all about the stocks you don't own. Herb Greenberg, who you've seen on CNBC and Street.com, famously said it's the stocks you don't own that matter. So you want to avoid stocks in weak industry groups. You want to know what stocks not to buy. We've seen some examples of that. You can improve the performance of your 401k plan by just eliminating bearish rated stocks from your portfolio. And of course, you can use put options to protect your portfolio or to play the downside. So part of playing good defense is to find stocks like Avalon Bay, buy put options or Bed Bath & Beyond, and turn lemons into lemonade by benefiting on the downside. Now, here's an example of a stock you didn't want to own in 2017. This is Allergan Pharmaceuticals. Again, a weak drug stock. Institutions have been selling it. I made this my bearish stock of the week back here in September when the stock rallied up from 219 to 233 on some absolutely trumped up story where they took the patents on their dry eye drug Restasis, sold them to a Mohawk Indian tribe in upstate New York to try and avoid patent litigation. Well, that didn't work because the generic drug companies pressed the flesh and pressed the point, and so the stock dropped from 233 all the way down to 170 in almost a straight line. Put options positions were wildly profitable. And this is an example of the stock you don't want to own, and also how to turn it on its head and make money on the downside. Now, I'm going to go back to what I said about relative strength. It stands alone as a bullish or bearish indicator. So here's General Electric, a one-year chart. The power gauge has been neutral, but look at the relative strength. It's been underperforming the market for well over a year. And along the way, we had those relative strength sell signals. We also had a money flow sell alert. Notice how the stock rallied from 26 to 28, gapped up on some good news on CNBC, I'm sure, in June, but money flow stayed negative. It wasn't as blatant as advanced auto parts, but it was there nonetheless, and it was followed by a relative strength sell signal. Remember, these are accurate 70% of the time. So even though the stock had a neutral power gauge rating, knowing that it was persistently underperforming the market, knowing that institutions were selling it, would have discouraged you from owning a stock that was down almost 3% today, making a new 52-week low. Relative strength stands alone on both the upside and the downside. If you're trading high momentum stocks on the upside, the power gauge is not bullish, you're on a high wire without a safety net. So you have to use stops and good money management to protect your capital. You can make money on the upside, but it's harder. So for instance, we just had a relative strength buy signal in Wynn Resorts. Neutral power gauge rating, but outperforming the market. If you go into that trade, you want to protect your capital with a stop loss and try and maximize your profits. Now, the rest of this webinar is going to be about earnings season. January, April, July, and October, we get quarterly reports from major companies that are on a fiscal calendar year. A lot of volatility during earnings season. Volatility in this case equals opportunity if you know what stocks to focus on. So what we're all about is getting you better prepared for earnings reports by helping you know if a stock will likely meet, beat, or disappoint Wall Street estimates. And it all hinges on the power gauge rating. A stock with a bullish power gauge rating is twice as likely to report a positive earnings surprise and therefore spike up. Not a guarantee, but it's a probability that you want on your side. Now, I'd like to start this final segment of the webinar by looking at a chart that we had in a webinar we did for John Carter's Simpler Trading audience on January 24th, just about a year ago of 2017. The day of the webinar, and this chart goes back to January of 17, the day of the webinar, D.R. Horton, a home builder, reported a positive earnings surprise. It had been in a downtrend, but it spiked up above long-term resistance, above the upper volatility bands, and I used this slide in the webinar. Now let's see what's happened in the course of the year. The power gauge rating turned bullish. The stock had a bullish personality change, and it was under accumulation by institutions all through 2017. Along the way, you had these oversold buy signals, positive earnings surprises, and back here in September, I recommended it as my bullish stock of the week when the stock was about 36.80, and it proceeded to go in a straight line to 52.90, 53. Notice how the institutions were buying the stock. How do we know that? Chaikin Money Flow was green. Even when the stock got oversold and pulled back or went sideways, institutions were buying this stock. Why? Because millennials are starting to buy houses again, and D.R. Horton caters to first home buyers. So from a positive earnings surprise, a breakout to the upside, a nice pullback to an oversold buy signal, this is a stock you wanted to be bullish on all through 2017. Now, we talked about advanced auto parts, which had that bearish money flow sell alert. In April of 2017, as we were waiting for earnings season to begin, the auto parts retailers were making new 52-week lows. So I made three of them my bearish stocks of the week: Advanced Auto Parts, AutoZone, and O'Reilly, and said sell them on strength, 2 to 4% rallies. And that's just what happened. Ahead of this May earnings report, we got an overbought sell signal, new 8-day high. Power gauge was bearish at the bottom of the chart. And the company reported a negative earnings surprise, dropped from 150 in a straight line, gap down to 130, eventually bottomed out around 100. Now, you had a second opportunity ahead of this earnings report. to put on a put position. And the stock did it again, gap down from 110 all the way to 88. So here's the progression. Money flow sell alert at 170. Pretty tough to pinpoint the top, but the sell alert can do that. Institutional selling, bearish personality change, power gauge bearish, market agrees with the model. That's your dynamic duo. You want to avoid this stock and look for put buying opportunities. Now, what's interesting is, and again, not a knock on a brokerage firm. In fact, we have a lot of Raymond James advisors on the webinar tonight. Raymond James, back here in October, downgraded the stock from strong buy to market perform. The stock was trading at 95, down from 170. Where is it now? It's 110. You cannot depend on Wall Street research departments. That's why we created the Power Gauge rating and Chaikin Analytics. We have advisors from some of the major firms like Morgan Stanley, Merrill Lynch, UBS, and Raymond James who are subscribers because they're looking for an independent source of research that's unbiased, objective, and works. And that's what the Chaikin Power Gauge rating is all about. Now, Mattel is another stock where there were tremendous opportunities during earnings season. Power Gauge was bearish, underperforming the market, institutional selling, and right ahead of these two earnings reports, one in April and one in July, you had a relative strength sell signal. Now, how can you envision what the profits look like if you pull the trigger on that signal and get a negative earnings surprise? Gap down, wonderful spot to take your position off, or at least half of it. And then 3 months later, the same opportunity. Now, I did this slide for a live teaching webinar that Jim Cramer sponsored in New York back in October at the Harvard Club. And Mattel was due to report a few days later. They reported a negative earnings surprise yet again and gap down 15.4%. This slide ends in October. It's not up to date. These opportunities repeat over and over and over again. Now, on the upside, here's an example from a webinar we did in May of 2016. Best Buy was due to report earnings 2 days later. It had triggered an oversold buy signal. The power gauge was bullish. It was outperforming the market. So I put this in the webinar. I said, here's an interesting call buying opportunity or a vertical call spread. Sure enough, following the pattern of positive earnings surprises, you got another positive earnings surprise when the stock was at 50, spiked up to 60. You take your profits, you say thank you very much. It then pulled back. You got another oversold buy signal and the opportunity to do it again. So these opportunities are there day in and day out during earnings season. Now, we got this testimonial, 257% profit in 24 hours on earnings. Gave options one more try and was surprised with the results. A Best Buy options trade was my biggest winner of the year. I don't think I would have ever attempted an earnings trade without the guidance in your webinar. So here's a real life example of a Chaikin member who experienced wonderful opportunity, pulled the trigger, and made fabulous profits overnight. Now, I'm going to walk down memory lane here to show you that this isn't just something that started working in 2017 or 16. It goes back to 2012. We launched this app in 2013. So Netflix, ahead of an earnings report in 2014, was trading in the 400, 440, 480 area. We had gotten an overbought sell signal rather. Featured this as our bearish stock of the week. People who bought out of the money puts when the stock spiked down over 100 points made 50 times in one day. Someone who took a saner view of this, John V, said, I recently subscribed to Chaikin. Using the upcoming earnings ideas in Chaikin Analytics, Netflix had a very bearish rating, bought 3 put options, cost of $7,000, made quick $21,000 profit. So people have been doing this. 100-point drop. Priceline in 2012, 100-point drop. I actually talked about this on Fast Money. John Najarian was on, said, well, I've been bullish on Priceline. That's the video you saw in the beginning, but I'm going to revisit that. John did. He converted his call position into a put position, made 23 times on his money, and talked about it the next day on CNBC. And one more example, LinkedIn. Before Microsoft made this outrageously rich $20 billion offer for LinkedIn, we had a reversal sell signal, one of our 6 signals, ahead of an earnings report back here in February of 2016. The stock disappointed and dropped over 100 points, dropped from 200 to under 100. We featured this the previous week in our weekly market insights as a stock to avoid or buy put options on. We had 4 or 5 of them. There was another stock that did something very similar. So these 100-point trades are not uncommon. They can happen if you've got the right tools and you're looking for the opportunities. So here's one in the making. Varian Medical just saw the power gauge rating turn bearish this week. It failed to make a new high. Institutions are selling it. They report earnings next Wednesday. Analysts are lowering their estimates. It's in a weak industry group. This is a potential gap down if there's a negative earnings surprise. So it's a stock you want to watch next week as we head into that Wednesday earnings report. Potential to put on a low risk put trade and see some very, very high returns if you get something like what happened back here a year ago with a negative earnings surprise. The stock dropped from 93 all the way down to 78. So this is a current example of what these trades look like in real time. So we've now covered the 4 ways to time winning trades, and everything we've looked at is embedded in Chaikin Analytics, which in May of 2017 won the Benziga FinTech Award for Best Stock Ideas Platform. There were 19 other candidates or people vying for that award. Now, Chaikin Analytics, at its core, uses that 20-factor model, the Chaikin Power Gauge rating, combines it with relative strength and money flow. We also have something called our stock discovery engine, and that's what we actually won the Benziga FinTech Award for. The ability to type in a symbol of a stock that you like or don't like, just like you would find music on Spotify or movies on Netflix, and immediately get back ideas that match that stock in a very sophisticated way, embedded in Chaikin Analytics. In addition, you get our screener. You saw the power of the screener earlier. Our options ideas module, so you can get high probability options ideas from a company called Options Play that we've licensed and put into Chaikin Analytics. And Chaikin Analytics is normally $2,195. You can go to our website, chaikinanalytics.com/earnings, and subscribe. But as a webinar special for the simpler trading community, we'd like to offer you a $300 discount, reducing the price to $1,895. chaikinanalytics.com/earnings. This offer expires January 21st, Sunday at midnight. Or you can go to sales@chaikinanalytics.com if you have a question, or 877-697-6783. Now, when we did that live webinar with Jim Cramer on a Saturday, that teaching webinar, you saw some of the slides. There's the 20 factors. Jim live tweeted, Chaikin Analytics model is the best, used it at my old hedge fund. And be on the lookout. We're doing a roundtable, Jim and I, 1 hour, the end of January, sitting around a table talking about stocks live just for the Chaikin Analytics community and the Street.com subscribers. So be on the lookout for that. Now, in addition to everything else that we looked at, you get intraday charts, so you don't have to run back to your online brokerage platform to see what's going on during the day. We have our earnings alerts and Chaikin Market Insights, my weekly newsletter. Plus, as a Chaikin subscriber, you get member-only access to our weekly strategy webinar with our market strategist, John Schlitz, unlimited coaching and one-on-one support, and then John Schlitz's daily morning insights, which comes into your email, tells you what's been going on overseas, pre-market. So it's a complete package. One subscriber said 10x return in 5 days. In the 5 business days that I've been using Chaikin Analytics, I've paid for the subscription over 10-fold. These initial results are nothing short of outstanding. Please extend my thanks to the entire Chaikin team. Team is the key. We've got dedicated customer success people who want you to be profitable in your trading and in your investing. We really believe in that. It's not a software product that you just get abandoned by. We're there with you all the way. So one final inducement to get you to take advantage of these powerful tools as we're just at the beginning of earnings season. If you subscribe by midnight tonight, we'll take an additional $100 off the cost of Chaikin Analytics, reducing the price to $1,795. That's a $400 discount. Plus, for the first 10 people who subscribe tonight, you get a one-on-one phone call with me. These have been very valuable. We've done them periodically over the last 3 years. First 10 people who subscribe tonight, these calls usually last a half hour to 45 minutes. I learn a lot, you learn a lot. That's our fast action bonus. $400 off the price of Chaikin Analytics. I'd like to thank all of you who stayed with us and turn it back to Joe Bochella, who's going to wind down the webinar.
All right. Thank you so much, Mark. And thank you, everybody, for joining us this afternoon. Again, Mark's offer is $1,795 for a full year to Chaikin Analytics. This includes all of the support webinars. There's been a lot of great questions that have come throughout the presentation. A lot of questions regarding spotting entry points and especially exit points as well. There was a good number of questions there too. We cover all of this on our support webinars that take place every day, every trading day, I should say. But we'd love to have you join us. The most important thing that we could have you do here first, though, is join us for our onboard session. That'll take place tomorrow at 2 o'clock Eastern Time. It would be a perfect way to see how the program works, how to hit the ground running, get up to speed, add your stocks to the program. And really, as a recommendation, I've been working with Mark for 3 years. The opportunity to have a one-on-one session with him is something that you do not want to pass up. So I would greatly recommend being one of the first subscribers to join us tonight so that you have the opportunity to join Mark for a one-on-one session. But until then, please make sure to join us. You can see the fulfillment page on my screen right now. Just go right to chaikinanalytics.com/earnings, or you can give us a call at 877-978-6257. In the meantime, everybody have a wonderful afternoon, and we will see you on tomorrow's onboard session.